Well, welcome to another Workshop Wednesday brought to you by schoolbookkeeping.com, helping you be the best bookkeeper that you can be, because Workshop Wednesdays is all about casual conversations for serious workflows. And again, you'll notice that Rachel has some explaining to do. No, Rachel couldn't be here today. So instead of us tag teaming on Shawn, it's just going to be me and Shawn talking here. But Shawn, go ahead and introduce yourself for those that don't recall or remember who you are and why you're here.
Yeah, thanks for having me again, Dan. My name is Shawn Coultice. I'm the head of channel partnerships at Katana. Been in the manufacturing and inventory space for over 15 years, helping implement and get solutions set up. And, am somewhat of a product expert around Katana. And so hopefully we can chat a little bit about some of the aspects of its solution today and how it compares to QuickBooks Enterprise and what the differences are.
Yeah, so this is part of our ongoing series of comparing QuickBooks Enterprise, the advanced inventory functions of the desktop product for someone or some business that might be considering this migration to the cloud, and whether or not those workflows will translate well to a cloud-based inventory management solution. And so that's why I really appreciate Shawn joining us here so that we can really kind of have that side-by-side comparison. So we've talked about in prior sessions or prior workshops the multiple inventory locations, knowing where your inventory is at any given time. And then last time we talked about the traceability aspect of lot numbers and serial numbers with expiration dates. And today we're going to be talking about costs, costing, and the various different methods that in general, as far as accounting is concerned, about the calculation of those costs. And I think the biggest I'm trying to think of the term or the biggest challenge I think that a lot of businesses and accounting professionals alike have with regards to cost calculation is the cost of goods sold when that happens, right? So it was often a misunderstanding, I guess, is the nicest way to talk about it.
Are you saying that people have it wrong, Dan?
Well, not necessarily that they have it wrong. They just have a misunderstanding of when things occur, right? So with dealing with their inventory, right? So most fundamental term or is the cost of goods sold, or the COGS, that is recognized, and when that is recognized. And I think the easiest way that a lot of people had that challenge is they're going out, they're buying products to sell, they want to recognize that expense, right? And they'll associate that purchase to cost of goods sold at that time, which tends to make things a little wonky. I think that's the technical term for it when you're looking at that on your profit and loss, right? Like, so if you go out and you buy, thousands of dollars worth of merchandise with which to sell, and you recognize all of that as a cost of goods sold at that time, your profit and loss is now upside down, right? Like it's going to take a long period of time to even get to that break even point where the revenue is going to overtake that cost of goods sold. And I think a lot of people in that are using a general ledger accounting software or tracking their inventory management will potentially put all that front loaded stuff up front and then wonder, well, I mean, it makes it really challenging for someone to see, well, when am I going to break even, because I've front loaded my cost of goods sold by doing that at that moment. So as we had talked about, with Rachel and yourself and various other discussions that we've had, that's a that's more of a not tracking inventory um, at all, where you're just accounting for that, whereas opposed to a periodic or perpetual inventory model where you're tracking the comings and goings of your inventory levels at any given time is going to be a better solution for that cost of goods sold calculation. And the way that I would explain it to folks is that cost of goods sold is cost of goods when it's sold, not because it's going to be sold. and that tended to make things a little bit more understandable for those that were just putting all those inventory purchases into cost of goods sold at the time that they purchased them, right? So that is kind of like the framework. So here you're tracking your inventory comings and goings in a perpetual state. And then it comes down to, well, how am I going to account for those cost of goods when I sell them? And there's a variety of um, methods to tracking that. And I found this article that I'm going to share here real quickly. It's actually on the Firm of the Future or the QuickBooks blog from 2 years ago, which is still holds true today, right? So there's inventory. The article title is Inventory Valuation for Costing Methods, and there actually are 4 methods of costing and cost calculation, and they all have pros and cons to that. So we're gonna talk a little bit about that here, and I'll share this article so that you can um, review it at another time. But there are 4 main methods of cost calculation. Uh, First in, first out, which is a term that I remember hearing during my first job when I was 15 years old at Burger King, right? Because uh, and this really talks to why you do these things, because especially when you're dealing with food or something that's going to expire, you want the first something that came in first or something that's prepared first to be the first that is let out, right? So you don't want a day old Whopper, uh, unless you like stomach illness, I guess that would probably be you wouldn't want to have that be the last thing that you or the first thing that you eat when it's the last thing that was prepared. So first in, first out is a cost calculation that is utilized, and they have this really nice thing. Is it right for my business? And they talk about those types of industries where food, beverages, cosmetics, pharmaceuticals, FIFO is the right inventory valuation method. Uh, and then the opposite of that is LIFO.
Just on that, Dan, just a quick
Yeah.
note. Like, I just think it's interesting that your costing methodology is driven by an operational requirement, right?
Yeah.
It's saying that it's nothing to do with the value of the actual products, and there's no financial sort of implication other than I think it had mentioned that your taxes might be a little bit higher, but
Mhm.
you're doing it to meet industry compliance from like a tracking and traceability perspective, which I think, kind of are two separate things, if the functionality is available. So just an interesting point to kind of
Yeah,
bring up on this.
exactly. And one of the things as I was kind of perusing this article is that there is a difference between cost calculation, as far as what shows up on my profit and loss, and inventory valuation. And this article is riddled with blurring those lines. And this is when I wish Rachel would have been joining us, because she might have added that you know accountant mindset of where that line actually is drawn, because there is a program functionality that's tied to these methods, and that may or may not be what the accountant wants to see on either their financial report for running an inventory valuation report, or looking at what do I have on hand versus what is the expense of such thing, right? So I mean, the whole purpose of doing a perpetual inventory, of managing the comings and goings of your inventory stock level, is to have a little bit more of a real time aspect of, as sales, purchases happen and the sales happen, what is the effect on the bottom line, right? And being able to have a better window or insight into how things are going, and being able to make business decisions based on those reports. Now, Shawn, is that what where Katana can help with these types of things?
Yeah, absolutely. So when you look at, so I, across my career, I've worked with companies that typically operate in two environments. Most of the clients or customers I've worked with are manufacturers, and so they'll often use standard costing, and that's usually going to be for larger enterprise organizations that want to sort of track variances but have a standardized cost, because it helps them forecast and plan out more effectively, and then they work off their variances. And then you have average costing, and that's where SMB mid-sized businesses typically would want to operate if they're manufacturing or buying and selling goods, and that allows you to sort of average out the cost of products that you currently have in stock, so that you understand your profitability. It's a much more accurate visual into your profitability on a sale by sale basis. So you really understand overall how my business is doing, and then individually, it can help it. You have that sort of detail level understanding of how profitable you might be. And then it's a separate system in Katana to track that FIFO. So, for example, our batch tracking capability operates in FIFO, but it can also operate in expiration date prioritization. So, I would rather, even if something is in first, so we have two products, one expiration date is before the other. I would prioritize the distribution based on the one that is closer to the expiration date, rather than
Right.
what was in first or not in first. So the functionality is built to meet that compliance standard, but also optimize how you're distributing that inventory so you reduce spoilage. And so those are things that are taken into consideration in Katana to support the operational side of the business, meeting that compliance standard.
Right, right. And as we'll uncover in the QuickBooks side of things, this will help with making of those business decisions, so that and you've seen it at the grocery store. Manager special, right, is typically a method that they use when something is getting dangerously close to that that expiration date, because they don't want to have that sitting on the shelf. Certainly, they don't want to sell an expired package of meat, and they certainly don't want to throw it away unsold. So there's all sorts of things that will help guide them on that aspect. But LIFO is the opposite of FIFO. It's last in, first out, and this is typically right for a business where they're purchasing low volumes of inventory but at a higher value. But all of these things are going to have an impact on the profit and loss. Whereas what they're saying about FIFO, it doesn't accurately show the cost because there is some lag, especially if if your costs are increasing, because typically that's what's happening in the world these days, is that costs are going up. And so it will take some time before the lower cost items actually are sold to show that accurate level of the inventory being sold. FIFO has the opposite problem, LIFO has the opposite problem. Whereas if those costs are going up, those higher cost items are going to be recognized as the cost of goods sold entry, as opposed to the FIFO. So you have the opposite problem. Your costs are heavy because it's last in, first out, and then we have this in the middle option of this weighted average cost valuation, where it takes the average of those types of things and spreads them out over time. So that is it's kind of like the happy medium of trying to find the right cost calculation method. And QuickBooks Desktop has always been weighted average, and Katana works in essence the same way. But as you alluded to, there might be other ways to accurately fix those costs in Katana.
So the costs in Katana it's a moving average cost, and what that means is every new piece of inventory I add into my my inventory will be against my weighted average of the cost that's already in stock, and recalculate that moving average cost. As I consume and take inventory out, it will always apply that moving average cost to that inventory. And so what that does is it helps avoid significant, changes in your cost. As you might have, especially in a manufacturing environment, maybe you had a machine breakdown and your operational cost was a lot higher on an individual project or run, but you have a bunch in stock that's ran at the regular rate. You wouldn't have all that cost associated to that in a FIFO environment or LIFO to one individual sales order. It's going to be averaged out over the total amount that's in stock, and so it helps sort of level out your cost. And in my opinion, you have a bit more of an accurate idea of profitability across the organization.
Yeah, that's a good point. So, the pros and cons of these first in, first out, or last in, first out are kind of smoothed out by using this weighted average method. Now, QuickBooks Online, if you're using QuickBooks Online as your inventory management solution, which we've talked about ad nauseum, that's only going to be like the reseller type of situation where I buy stuff and I sell that very same stuff. It will only use first in, first out. So you only have that option with QuickBooks Online, which then leads to, well, if I'm transitioning from Desktop Pro, which was weighted average, to QuickBooks Online, which is now FIFO, I got to tell somebody about that, and that's typically the government, right? And then there's some compliance issues and things like that, because now that that we're kind of talking about this, it's like, okay, first in, first out is going to recognize the slow is going to be a little slower in recognizing higher costs on the cost of goods sold, where weighted average I'm getting choked up about all this. Which is weighted average is going to have this be a little bit higher on those costs, right? So you can't just change that midstream, especially mid-year. You gotta work with your accounting professional to make sure that you're in compliance of all of those things. And then the last, I really didn't realize that there was a fourth option until I read this article. But this is specific inventory valuation method. Basically, you're calculating cost on a per item basis, which is going to be extremely rare. But this is really for only limited types of goods, which is suited for valuing rare, high value goods, which in which the differentiation is necessary. So I'm thinking like cars, uh, art, jewelry, those types of things where they have a high value associated with it, and from one to the other is going to be a specific. You want to track that particular cost of that particular item. Um, through its life cycle of purchase, manufacturing, receiving, and sales. So those are the cost calculation methods, and certainly read about that as we've shared the article here. But how does this all equate to QuickBooks and or Katana, right? So in in QuickBooks Desktop, you have the choice of first in, first out, or weighted average when you're using Enterprise. So I'm going to just choose, go into the preferences here and just illustrate where that actually is. There's a FIFO tab here in the advanced inventory settings. This actually is fairly unique in that it's just a checkbox, which sounds harmless enough. You can just check this off, and then you can put the date of calculation. And then what QuickBooks will do is it will recost allocate all of your inventory items from that date, from going from weighted average to FIFO or back again, right? So this is not a check mark to be taken lightly, especially if you have a lot of transactional information for all of these transactions coming in and shipping and receiving and selling these things. It's going to take some time for QuickBooks to do this recalculation method. But one of the things that this FIFO unlocks by turning it on is an inventory aging report, right? So by running this report, I'm going to go inventory and inventory aging summary. Apparently, there's nothing aging here, so it's the sample company. So this will list every inventory item, the average days in stock that it has, and just like a valuation. I'm sorry, just like an AR aging where it's got a date range of 1 to 30, 30 to 31 to 60, and so on and so forth. You can see the value of your inventory and how long it's been sitting on the shelf, so that you can start to make decisions based off of that. If you're using weighted average, this report doesn't even exist. So you have to have FIFO turned on inside of QuickBooks Enterprise in order to even have this functionality in this report. So you're not going to glean these insights if you don't have first in, first out turned on. So there is that. And then you were mentioning, Shawn, in Katana. I'll just turn on your screen there. In Katana, these things are all weighted average as far as the cost calculation, but you have this traceability aspect that can use specific costs for various manufacturing runs and itemized sales.
Well, the costs themselves are still always going to be weighted, but the batch that is applied to the order will be recommended to be taken out of stock based on the expiration date. So essentially, you're following that that FIFO methodology from a operational perspective, right? So your FIFO first in, first out, from making or receiving goods to making sure you're not having old stock being pushed to the back of the shelf, essentially. It's always going to be grabbing the oldest stuff and shipping that out. So you're constantly turning over your inventory appropriately. So Katana is going to help that when you turn on batch tracking. But from a costing methodology perspective, it's still going to be using moving average costs to calculate the cost of that good. So for that individual SKU or product, when you have that in stock, the system is going to, you maybe have 5 batches in stock. It will pick the batch that is oldest, and it will apply a cost which is averaged across all 5 of those batches.
Got it. So, so as it won't necessarily associate the cost of that particular batch when you sell it, it helps make those decisions based off of upcoming expiration or dates associated with that, so you don't fall into that. Oh, I have to create a manager special or deeply discount this item, or spoil it, throw it away because it has actually expired. So in regard of the cost, it's always going to be weighted average as far as the cost of that sale that occurred. It's just helping the business owner make better decisions of which ones should actually be part of this sale. Is that right?
You got it, exactly. So if you were to look in, for example, when I turn on in my settings here, I turn on in traceability, I think it's called, integrations, clear, maybe barcoding. It's under there. No. Anyways, I can't remember exactly, but when you turn on,
you'll have to watch the previous workshop where we talked about the traceability of where that actually is.
Yeah, but once you have that turned on, I'm sure it's in here somewhere, and I'm just not. My eyes are probably not seeing it. But sorry. So if I were to go now into my stock screen and I look at my batches, okay, so I have these batches set up in the system, and I have this expiration date and created date. Okay, so these dates are going to be referenced when you go and pick, your milk. It's going to go and pick the milk that first it's going to look at the expiration date. What is the closest expiration date for the batch that you're picking? And then the next is going to look, if that is blank, you don't have an expiration date, it's going to look at the created date. And it's going to find the product that is oldest. So where that batch was created in the system from either a purchase order or manufacturing order, it's going to find the oldest one for you to go and pick and fulfill that order.
Got it. So the other aspect of the cost calculation is dealing with landed costs. Can you talk a little bit about what that is? So let's define that first before we go into the minutia of what these programs offer as far as that option.
Yeah, and I think I'll just open up a PO to help explain that. So here's a purchase order, okay, for our paint supplier here. I've got brown paint and black paint that I'm purchasing. I've got just over 71 liters here and 1 liter here, and I've got a unit price across each one of these. But I had some additional costs in pulling in and actually receiving in that product that aren't relative necessarily to the individual line items that I'm buying. It's a separate cost, but I need that cost included in my line items to have an accurate cost of goods sold and an accurate moving average cost in Katana. And so what we're going to do, or what the system does, is you have a distribution method. So I'm going to distribute this by value. So it's looking at the dollar value of the goods per unit, and it's dividing that up and applying this $100 across those units. And so based on that information, I go from a unit price of $8 per liter to $9.38 per liter. And we're mixing metric and imperial with the US dollar and Canadian measurements. But anyways, I'm pretty sure you guys don't buy paint in liters. In Canada, we do.
Right.
So anyways, so you have $8 here, but it actually is going to be put into my inventory at $9.38. Same with this black paint, which was $7 or $6.10, is now $7.16. And so that's the actual cost that goes into my inventory is my purchase price plus any additional costs equals my landed cost.
Now with Katana, in setting up the landed cost, is that just a check mark? Is there what kind of preferences does that entail when you're actually calculating the landed cost? Is there any options of how to spread that across, or is it just kind of built in where it's going to take the two different items, split that cost based off proportionately off those two different items and the number of quantities that are in there?
Yeah, so you do have the ability to select like non-distributed, and then you can manually apply it across the two or whatever items you have, if there are multiple items on the PO. Most businesses are going to do it by value, just because at the end of the day, it's usually the most accurate. So let's say you're shipping a container and you're receiving that container, and the items that are more valuable, well, they should take up more of the cost to ship that thing. But you can think of maybe if I'm shipping marshmallows, which are cheap but take up a lot of room in the container, and then I've got gold, which is going to take up a small amount of time within the container, but it's expensive. Maybe that's a situation if you're shipping marshmallows and gold. You wouldn't want to do it by value, because the marshmallows take up a lot more of that container, and that's why you had to pay more for shipping.
But what if you're selling golden marshmallows?
Golden marshmallows, we might be onto something. But for the most part, I think by value, there's a couple different methods that and we did look at adding them, but we felt like when we were working with the product team and our customers, we've got 1,500 customers, and we talked to not all of them, but a lot of them about adding in this feature. And one of the things that we realized is you need to make it easy so that people can be compliant. So if you go and start messing around with people having to do it manually, or there's a couple other methods to doing it, the compliance goes down, and then you're not using it, and you're not receiving your products with the appropriate landed costs, and then therefore you think you're more profitable than you are, but on an order by order basis. And so that's where by value just seems to be the easiest way to have it applied automatically.
Yeah. And from what I'm gathering from what you're showing me here is that landed cost is going to be calculated on the transaction, on the bill or the receiving, based off of as you need it, right? So that's one of the things that I'm seeing that is glaringly different between how this is handled inside of QuickBooks Enterprise versus Katana. Is that pretty much the
That's exactly true. Yeah, like so if I was to go and create like a new PO here, okay. So I've got my PO, and let's say I'm going to buy some more paint, right, from a paint supplier, and it's already telling me along the bottom here, I've got some items that I could go and buy from this paint supplier because you're short on them. Oh, let's go and add those to my order. In this case, it's brown paint and beige paint. Now, maybe I'm buying this from the guy next door, and there's no additional costs. I don't need to go and apply, additional landed costs to this. But if there were, I would just hit this additional cost button, and then I can go and apply those. And so that would then, when I receive it in, be allocated to my inventory value in Katana. But actually in QuickBooks, when we send that over, if it's associated with the bill and that supplier, that would just go over as an expense, because it's not something that you're valuing in your inventory from a financial perspective. So it goes into Katana and will be associated to your cost of goods sold, but it already gets expensed actually on your PO.
Got it. So let's switch these around here. So yes, I can do that. That's good. So here's QuickBooks, When we go into the advanced inventory settings again, it seems harmless enough. The landed cost tab, you would just really be setting up that landed cost. First, you got to sign in, and then once you do that, you have you can use an existing account, right? So you're going to be choosing basically a holding account for all of those costs that you're going to be allocating, and then doing it later. So that's a big difference between what you're showing in Katana versus what we have as far as in QuickBooks Enterprise. But you're going to be specifying an account, and you're going to be specifying the account type, which is typically another current asset to put all of these costs that you're going to be allocating into a holding bin. And they recommend other current asset, but due to feedback, people wanted to put it in a cost of goods sold account. So this is where you have that. This is what I want to see, and this is what my accountant says I should put it in. Are two different things. And then once you've specified and walked through this process, then all of the bills that are associated with those with that item or with that account will put that into that holding bin. And then the next thing that you're going to be doing is I don't know if I turned it on or not. Oh yeah, so you do have a feature or a function from the inventory menu to calculate landed costs, and you're going to be doing that after the fact. So rather than doing it on the bill itself, where you have those other expenditures, it's going to go into that holding bin at that time, and then later you're going to go in and calculate the landed cost of those items and spread those fees. And you have the choice of to do it proportionally based off of the items that were received or the value, in your example there, of spreading that cost, how you want to spread that cost across those bills and those items. But the main point is that those items aren't going to be that cost isn't going to be calculated until you've gone through this process of calculating the landed cost and spreading that out. So to your point, that may not happen until they realize, oh, well, this wasn't this wasn't calculated properly, and then they have to go back and do that, which will then alter other financial reports based off of that cost calculation. Is that what Katana's realized? Is that
Yeah,
not, if they're
we
not doing it and they have to do it later, they fall out of practice, right?
Well, exactly. Like one of the things that was pretty common is like there were other solutions that we looked at in the market, and there was just a lot of complaints around the complexity of actually utilizing the landed costed feature. And so one of the things that, and with anything in Katana, we want to highlight is ease of use. And so the ability to apply the landed cost associated to a certain purchase order, have that divided up over the value of your inventory, just seems appropriate. And then we'll continue to kind of build out on that. One of the things that we're looking at doing is the ability to create a purchase order, because sometimes you would, for example, you might have a bill come in that should be applied to multiple purchase orders, right? So you have a container load that contains maybe a dozen purchase orders from China, and now you want to take that container load cost, duties, whatever you've incurred, put that into a PO, and then land that cost across all 12 of those purchase orders. So that would be an example of something that we're working on building out in Katana. Will come out next year, but that's a more advanced landed cost situation. 90% of use cases can be handled directly within Katana. and, with the feature that we released, and it just makes it a lot easier to be compliant.
Now, with I just want to make sure I'm clear in understanding the Katana functionality. That as soon as you put another cost on a purchase order or receiving document, it automatically will give you that choice of calculating the landed cost at that time.
Yeah, exactly. So when you put in that, yes. So it by default will say, by value essentially. So it essentially, because you're assuming, I guess the assumption was if someone's adding a landed cost to a purchase order, they probably want to land that cost across the line items that are on that purchase order.
Right.
And so it does that automatically. But if for whatever reason you didn't want that additional cost actually associated to the individual line items, you can turn that by value off, and then it won't be applied to the individual line items, but you will have that additional landed cost still sitting on the PO.
Gotcha. And what you were just talking about is that if it's not at the time of when they purchase it, like it comes through later, like a shipping bill comes in as not part of the that use case is being worked on.
We could. Sorry, I didn't mean to cut you off, but we can do that today. Like you could, if it's relative to that individual PO, I can go in and add that landed cost to, excuse me, that individual purchase order. That's no problem. It's the situation where you're trying to land that cost across multiple purchase orders. That's where it gets a little bit trickier, because you can see we're operating on the individual purchase order level where I'm putting in that landed cost. So that is a little bit of a limitation today. Really only applicable from what use cases we've seen is when you're ordering container loads from China, which have multiple POs associated to them, and you've got one shipping cost.
Okay. Well, I appreciate you joining us here and taking a high level deep dive into some of this functionality. So next week we're going to be, all of us are going to be off because we're going to be at Intuit Connect and seeing each other in person, which will be really cool. So we'll skip over next week. We'll have a replay during that time period for those of you not attending Intuit Connect next week. And then after that, we'll talk in a little bit about building assemblies and those types of things with Shawn. So hopefully you join us next time on the Workshop Wednesday, and we appreciate you joining us. Any closing thoughts, Shawn?
No, I think the costing methodologies between the two systems. One thing that I think is just worthwhile mentioning, Dan, QuickBooks Online operates, like you said, in FIFO. Katana integrates with QuickBooks Online and operates in moving average costs. So one of the common questions we get is, well, what costing methodology are you using then? So I know you wanted to wrap it up, but quick note, because Katana operates at moving average costs and we're pushing over that cost value of inventory to QuickBooks Online, that enables you to operate in moving average cost or weighted average cost. So in that scenario, that's what happens.
Right, because you're not even tracking the comings and goings of your inventory items in QuickBooks Online at all. You're doing that all in Katana, and that is just telling QuickBooks the financial impact of those comings and goings from Katana into QuickBooks, right?
You got it, exactly. Thank you, Dan. I didn't mean to.
No, that's an important distinction to point out, is that, well, if QuickBooks Online is only going to do it this way, that's certainly a valid point that we want to make sure that is covered, because they are talking in two different languages.
Right.
All right. Well, we'll see you next time on the Workshop Wednesday, and we hope everybody has a great day.
Thanks a lot.